What is the world's most important number? No, not pi. It's LIBOR, the London Interbank Offered Rate. LIBOR, what is it good for? It's the benchmark rate for $200 trillion of derivatives contracts, loans, bonds, and securitizations. That's in the US alone. With other IBOR-based instruments, in Europe and Asia, estimates are over $400 trillion. The numbers are dizzying. LIBOR is being replaced with SOFR, the Secured Overnight Financing Rate, by the end of 2021, which is really not so far away. Here's a quick comparison. LIBOR, unsecured, so there's a bank credit component, bank funding only. Term rate, forward-looking, futures exist. SOFR, secured, it's in the name, based on US Treasury repos. Reflects the view of many other market participants. Overnight rate, backward-looking, term SOFR doesn't exist yet. And how closely do they track? SOFR tracks lower and it's more volatile, especially at month ends and quarter ends where fair values are determined. Compounding, term structure, spread adjustments are being introduced to maintain economic equivalency. Switch will be based on the fallback language in the legal docs. For some corporates and mortgage-backed securities, fallback rate will be the last published LIBOR, so the bonds will effectively start paying fixed rate, affecting economic value and creating an asset-liability mismatch. Keep in mind, some of these contracts were written over a decade ago, when LIBOR going away was unthinkable. So the fallback switch to last published LIBOR was meant to address a short-term absence of LIBOR, not wholesale discontinuation. There will be potential legal, operational, and economic impact. Let's just focus on the economics. What will be the valuation impact? Here are some steps to figure it out. 1. Build an inventory of your LIBOR exposure across assets and liabilities for contracts that extend beyond 2021. Keep in mind, some short tenor derivatives may expire by 2021, but mortgage assets will still be around. 2. Understand fallback language and replace rate for each transaction. 3. Determine the potential impact on valuation, i.e. value transfer, due to both benchmark rate change for the payment calculation from the asset and due to new rates being used as a valuation input when discounting cash flows. 4. Determine basis risk, i.e. the mismatch of payments between securities and assets collateralizing those securities. 5. Update valuation models to handle transition and calibrate to future market practices rapidly. Get in touch with Methodical. Let's discuss how we can help. Methodical, expert valuation and advisory across every investment landscape.